So one of the hottest topics today is the impact that inflation will have or will not have on markets. And we're going to review a couple of the ways that you can protect yourself from inflation, or the best inflation hedges. And then we're going to show a really special, unique product that we've created with one of the banks that is going to help maximize the return on that particular aspect. So let's review some of the ways that you can easily protect your portfolios against inflation. And that is to own financials, which would include Canadian banks, insurance companies, etc. Why that is because rising interest rates that are caused from inflation actually improve the interest and margin spreads at these financial companies. So their earnings and their profitability goes up, hence their stock prices and dividends and everything perform well. The second would be commodities, or oil and gas, commodities, materials, etc. As the world starts to spend more money and start to utilize more goods and have more velocity, which drives inflation, means more use of these commodities and these materials. So positioning yourself into energy, oil and gas, mining and material companies and equities would do very well. And last would be one that everyone is familiar with in Canada, if you've read the headlines lately, is real estate. As money and velocity of money increases in society and drives inflation, what happens is the materials go up in value, the cost of construction goes up, hence the cost of existing homes and home values across the globe. So now let's talk about a unique structure that we have put in place that will have our clients help take advantage of inflation by investing in the Canadian banks. So there's a unique index structure called the Selective 5% AR Index. What this index does is it invests in Canadian banks, but also pays out a 5% distribution on the return of that basket of banks. The dividends of these banks are not 5%. So that means there's going to be an approximate, at current dates, 1.7% drag. So that's the opportunity cost of that index. Now what the upside is that this structured note will be able to provide 620% upside of the price return on that actual index. So for an example, if that index is up 1%, you will be up 6.2% over the term of that note. If they're positive by 10%, obviously it's going to be 62% return at the maturity of that note. It's a 7-year note, completely liquid. That means you can sell the note at any point in time in the secondary market, but also realize that the full delta, or the full 620% upside, does not kick in until the end of the note, which gets closer to maturity. But we've had tons of experience with these structures over the last 10 years to help drive additional upside for clients without additional risk, because what happens is, should that index falter or perhaps provide a negative return, at maturity, you would have the same one-to-one downside risk that you would have as owning the underlying, but the advantage is any positive performance is going to provide that massive upside. So that's a unique structure that we're proud to present and place within our client portfolios. If you have any questions about this, reach out to us. I'm happy to go through those details, but from time to time, there are these unique structures that can help drive returns in your portfolio and help protect against things like inflation, and this is one of those circumstances.